Breaking news from the Fed. Steve Liesman joins us now to try to fix it a little bit. What they
I
break?
got it under control now.
Okay.
And this is a new feature, right? This repo thing that Fed's been doing because we've had this dislocation of the overnight funding rate. This looks better, I have to tell you, because the Fed offered $75 billion of cash to do repo overnight.
Oversubscribed?
And it was 75.5. This is the closest they've been to meeting the demand out there in the market. The stop out rate, which is the low rate, was 180. High was 185. Low was 180. Weighted average 182, which is closer to where the Fed wants it to be. I'm talking about the Treasury issuance, which was $59 billion. They offered some agency, some mortgage back. So, it may be that we've gotten sort of further from the events that were out there. The tax payments, the Treasury issuance, even the Saudi Aramco thing has been mentioned among some traders as that they all of a sudden needed some cash, and so they withdrew from the repo market. These things take time and they can come back on their own, and there's three solutions out here. One is that the Fed keeps doing these temporary operations. Two is it creates a permanent standing facility to do these sort of things. And then three, which Powell told me in answer to my question on Wednesday, we allow the balance sheet to begin growing again. Estimates I've seen was that it would create natural growth to the balance sheet, $8 to $20 billion a month of additional growth out there. And some people are trying to call this QE light.
It is.
Trying to dissuade them from saying it's QE light because it's natural growth to go along with the growth of the economy. The balance sheet in the old days, when it was $800 billion, not $3.8 trillion, used to grow anyway. Right, it used to grow along with the growth of currency.
Yeah, but is this the new normal? I mean, this is Mohammed Al-Arians. We're never getting a balance sheet that is anywhere near the size that it used to be.
If I could parse your comment there, the new normal is the Fed is operating with a much, much bigger balance sheet that's bigger than the Fed estimated it was going to be when it already knew it was going to be bigger. The old new normal is that it's going to let the balance sheet grow again. To be, I guess.
But you never got to take away all that excess liquidity.
You never took it out. But the problem you have is you have a situation. You've dramatically changed the rules of what the banks need on hand. And Jamie Dimon will talk about this. Anybody will talk about this. Your need for excess reserves, more reserves against stuff that's out there. There's liquidity ratios.
In the economy and was out there, and because we're forcing them to hold it, then
they need more reserves. How do you know how much more reserves are needed?
Yeah.
You get to a situation where the repo rate blows out. So this is, some people said the Fed should have seen this coming. The Fed sort of argues, we didn't know, the market didn't know, nobody knew. How do you know when there's too little stuff out there? The price rises. And so now they know that they need to put more supply into the market to get a feel for where this thing should be in the new normal.
Are there any potential bad things down the road? Okay, we're just going to keep a big fat balance sheet, and that's the way it's going to be. What's the unintended consequence or the eventual consequence, or are there any?
Well, I want to answer that in two different ways. Are there any problems with this dislocation in repo? So imagine there's a small hedge fund out there that can't finance its stuff overnight. Yeah. All of a sudden, you start to have the doubt come through that the counterparty risk is out there. This is not happening now, folks. This is not that situation. It's that situation that everybody wants to avoid, where all of a sudden, I don't want to trade with Joe.
They're yelling at us, so we got to go. But what the heck happens in that situation if we don't really need it now and we're already using this? So what do you do if there actually is a situation where that's needed?
Where that's well, then you have.
We have an $8 trillion balance sheet that we're going to be dealing with.
I suppose you provide the amount of liquidity needed to hit your target funds rate. That's the goal here.
This reminds me of the old Jay Leno potato chip commercials. Don't worry. Go ahead and eat them all. We'll make more.
We'll make more.
Right.
Exactly, Becky. And we can talk about the other part of your question, which is how much it matters that if they have this ever-expanding balance sheet. People argued that it was a potential risk out there. Seems to be okay right now.